Bitcoin just bounced off one of the deepest pullbacks of the year. After weeks of pressure, the market finally caught a bid, and now everyone's asking the same question, and it's a natural one. That is this the start of the real recovery, or is it just another short-lived bounce before the next move? Well, today we're going to break down what's shifting behind the scenes from the Fed's liquidity pivot to the flow of institutional capital, and whether this could be the setup that pushes Bitcoin towards a new all-time high. And by the way, today marks Bitcoin's 17th anniversary since Satoshi Nakamoto released the white paper. And 17 years later, that same idea is still shaking the very foundation of global finance. What a beautiful time to be alive. So all right, let's get started. So as I said, something major just shifted across the global system. As we know, the Federal Reserve has already cut rates and confirmed that quantitative tightening will officially end on November 1st. Now, that single decision marks the end of a 2-year liquidity drain that has weighed on every risk asset in the world. While that policy was in full force, the Treasury General Account, which is basically the government's main cash balance at the Fed, kept building. It's now sitting near $965 billion, about $150 billion added in just October alone, pulling cash out of the market when it was already running dry. And at the same time, banks have been parking even more reserves in the Fed's reverse repo facility. So all of this created the tightest liquidity conditions of the entire cycle, the part of the curve where everything feels frozen, but cycles move in waves, and the next one is already forming. Now, I know the constant up, down of the market can give someone nausea, could make someone seasick. But remember, it's the ones with the stomach of iron, those that have their sea legs and know what they've invested in, that will make it into the 1% Bitcoin club. So I really hope that's you, and I hope you're able to anchor yourself despite the volatility in the market, because Bitcoin is going to $1 million someday, and that's all you need to know. Anyway, as the government reopens and spending starts flowing again, that parked capital begins returning to the market. Then once quantitative tightening officially stops in December, the direction of money flips from contraction to expansion. And historically, when the Fed stops shrinking its balance sheet, Bitcoin reacts within weeks, not months. And that's the phase we're entering now, so just brace yourself. Every time the market starts to move, the same headlines return. Warnings of a looming recession, whispers of a slowdown, calls for caution. Be ready for that. But when you look past the noise, the data tells us a very different story. Credit spreads are tightening. S&P 500 companies are posting some of their strongest earnings in years. Growth nowcasts remains solid across the board. Even the Citi Economic Surprise Index, which tracks whether the economy is outperforming expectations, keeps climbing week after week. So if we put all these pieces together, one big picture stands out. Policy is easing while growth holds firm. That's one of the most bullish combinations risk assets can ask for, and you can already see it reflected in the charts. The S&P 500 has stayed above its 50-day moving average for 125 consecutive sessions, the longest streak since 2011. So this kind of resilience doesn't happen in a weak economy. It happens when liquidity is quietly returning and capital is rotating back into the system. Right now, stocks, gold, and global liquidity indicators are all moving in sync, and they're all pointing in the same direction: expansion. So if the macro picture looks so strong, why hasn't crypto kept up? Part of the answer lies in how money actually moves through the system. Right now, banks are leaning on the Fed's repo facility more than at any point since 2020. That spike signals short-term funding stress, which basically means banks are borrowing overnight to cover temporary cash gaps. It's not a sign of collapse, just a moment of strain. And when that pressure eases, liquidity always flows back into the market. And that's when things start to shift for crypto. The heavier drag isn't mechanical, it's psychological. After one of the toughest months of the cycle, traders are exhausted. But if you are a fundamental investor in here because you understand the value of Bitcoin and the blue chips you're holding, you should not be exhausted, actually. You should be seeing this market activity as a bit of a show, just sitting back and observing. Now, if you are feeling stressed, just to take a moment to address that, then perhaps you're over allocated, because you should never jeopardize or spend any money that you actually need to live on and pay for your life, your family. You should never have that money in the market. It should be your, I don't want to call it your gambling money, but it should be money that you can part with, make money on, be ecstatic about, lose money on, and not cry about. So if you are feeling stressed right now, then this is a moment to re-examine what you're doing and how much you're allocating into the market. But moving on, we know that October brought ETF outflows, DAT unwinds, and waves of retail capitulation. Miles Deutscher explained, market making desks are still cleaning up from that damage. Retail has tuned out and ETF demand has dried up. That kind of environment breeds disbelief. So you shouldn't be surprised by looking at what crypto Twitter looks like and hearing the pessimism in the market. It's to be understood. You have to understand who makes up the market. Anyway, as people stop caring, stop watching, stop expecting upside, that's usually when the setup flips. So you have to stay plugged in, stay watchful, because when liquidity returns and no one's positioned for it, even a small spark can trigger a major move, and you want to be ready. Now let's talk about the institutional signals flashing green, because while retail traders are hesitating and exhausted, institutions have kept moving forward, which is what we should be paying attention to and who we should be modeling after. And we see that strategy just met all the criteria to join the S&P 500, a Bitcoin-heavy company entering America's most important stock index. That alone shows how far integration has come. Even Jamie Dimon, one of Wall Street's most cautious voices, now admits that blockchain, stablecoins, and smart contracts are real and here to stay. Hearing that from a longtime skeptic shows how quickly the narrative is changing and at the top. And Michael Saylor has taken it even further, revealing that major US banks are preparing to buy Bitcoin, custody it, and issue credit against it by 2026. That's no longer speculation. It's the traditional system building bridges straight into Bitcoin. So you better believe that will eventually pump our bags. And ETF flows tell the same story. While Bitcoin and Ethereum products saw nearly $500 million in outflows, Solana's ETFs quietly pulled in $37 million, a clear sign that risk appetite is returning beneath the surface. Institutions are already repositioning during this disbelief phase. As they do, this is when you actually make money, by positioning yourself in when prices are cheap. And they do this while retail is still in disbelief too. They're taking advantage of our fear, which is why I encourage you to not be fearful. If you can buy more Bitcoin, buy more Bitcoin, buy more Ethereum, buy more Solana, buy the key strategic blue chips I talk about all the time in my show, buy SUI, though this is not financial advice. Anyway, now let's shift gears and talk about the technical structure, the line that matters right now. Because despite all this noise, fear in the market, uncertainty, Bitcoin's structure remains intact. The weekly 50-day moving average, for instance, which is around 102.7 thousand, has held since early 2023. That line has quietly defined this entire bull run. Every touch became a higher low, and every rebound built on the same base. Altcoins echo the pattern too. The total 3 chart, which tracks the broader market outside Bitcoin and Ethereum, still holds a 6-year trend line, with 2021's highs now acting as support. That's the kind of setup long-term investors wait for. Deep consolidation resting on historical strength, and that's what we have right now. Exhaustion signals are flashing too. The others D monthly RSI just hit its lowest point in crypto history. Level seen only before major multi-month reversals. Sentiments line up with it. The fear and greed index dropped below 30, while Bitcoin trades near cycle equilibrium. Each time that combination appeared during this cycle, it has marked a local bottom, followed by a strong recovery. So if we put it all together, structure holding, sentiment drained, and liquidity turning, you get the compression pattern that usually forms right before a breakout. Technical exhaustion is meeting macro expansion, and that crossover often marks the start of the next major phase for Bitcoin. The first signs of that shift are already appearing in global liquidity data. So now let's talk about what we should be watching next, because the liquidity squeeze that defined October is finally easing. As the government reopens, the Treasury General Account begins to draw down, releasing billions back into the market. Next comes the bigger shift. The Fed's quantitative tightening officially ends on December 1st. From that point forward, the balance sheet stops shrinking and money begins expanding again. Those two moments, government spending returning and the Fed pausing quantitative tightening, have triggered every major bull run phase in the past. And the setup is already in motion, which is what you need to be excited about. The only question now is how quickly this next wave of liquidity will reprice risk once it starts to move. So as we close out today's video, remember, Bitcoin just bounced, but the real move begins when liquidity turns back on. So you just have to be patient. Every signal, macro, institutional, and technical, point to that moment getting closer. This is where disbelief turns into discovery and patience turns into positioning if you are steady and brave and understand what you're doing. So if you don't feel confident in your holdings, maybe this weekend you should take some time to go read the white paper of what you're holding. Go read the Bitcoin white paper, especially since it's its anniversary. Understand what you're holding and go look at the partnerships. Go look at the development happening with the tokens you're holding. If you're holding tokens that don't have any major partnerships or developments happening, then maybe you should reconsider what you're holding, is all I'm going to say. Anyway, stay sharp, stay early. Keep believing, keep your eyes on the goal, keep your eyes on the data, because numbers don't lie. And once liquidity starts flowing again, markets don't climb. They reprice in an instant, which is why you have to stay ready once again. So if this breakdown helped you see the bigger picture, make sure to subscribe, drop your thoughts in the comments section, just say hi. And join me here on Monday as we pick up again, covering whatever happens over the weekend. I love you guys so much. And remember, the next phase of this cycle is already taking shape, and you'll want to be here when it breaks.